Good morning, everybody, and welcome to our webinar this morning, SIPP or SSAS. And this is the first of a series of 3 SSAS dedicated webinars that will be running over the next couple of months or so. So this session, SIPP or SSAS, the aim today really twofold, I suppose, to do a high-level compare-contrast between self-invested personal pensions and small self-administered schemes. And also just to give a high-level overview of what a SSAS is as well. Second webinar in the series, we're going to probably do a little bit of a recap of some of the content of today, but the main focus of the second webinar will be, so why would you want a SSAS? What's the benefit? What are the angles? What are the opportunities from a planning perspective? And we'll be using a few sort of short, sharp little case studies to illustrate some of the opportunities that a SSAS can offer. And the third session, I think we've titled that one up Myth Busting, and that's going to be a panel discussion type session where we're going to be trying to deal with a lot of the frequently asked questions that come in with regards to SSAS and to try and demystify it really. So that's going to be perhaps looking a little bit more detail at perhaps the paperwork, what is involved actually, what's involved in getting a SSAS up and running, but also just as importantly, some of the day 2 issues. You've got the SSAS, it's up and running, but now you've got a client who wants to draw benefits. How does that work? You may have a member of the scheme that dies. What happens? Or they want to transfer away. So some of the ongoing and administrative stuff that's involved. So why are we running a series of webinars on SSAS? Well, first of all, quite simply, we just want to raise the profile, and clearly want to raise the profile of the Talbot and Muir proposition because it's great. So raise awareness, raise opportunity. Raise awareness more generally, though, and to sort of illustrate that, I'll use myself as an example here. So my financial services career now extends, just over 26 years. I'm a technical sales manager, so hopefully my technical knowledge of technical issues relating to financial planning for retail clients is, hopefully pretty solid. I'd like to think that my pensions technical knowledge is pretty solid. I know what a SSAS is. I know who can have a SSAS, and I kind of know why you might want one. However, if I was being really, really honest with you, I would have to admit that throughout my 26 years, the vast majority of my relationship with pensions and my interaction with pensions has been in respect of personal pensions and SIPPs. When I joined Curtis Banks, Talbot and Muir, of course, being part of the Curtis Banks group, I joined Curtis Banks, 3 years ago? And I probably had more direct exposure to SSAS in the last 3 years than in the previous 23 years. And I thought that would resonate with a lot of you guys. You could have a financial services career, 10, 15, 20 years plus. Doesn't mean you've necessarily had an interaction with SSAS. So if we raise awareness of it, demystify it a little bit, it might raise some opportunities. So on that point, though, of direct knowledge and understanding, I'm absolutely delighted to say I'm not presenting this session on my own today. I'm joined by Gemma Fenton. Gemma's head of distribution at Talbot and Muir. So as well as having a really strong technical base in terms of SSAS and SIPP as well, for that matter, perhaps more importantly, Gemma has absolute hands-on knowledge and understanding. SSAS is her bread and butter business. It's day to day. And in her career, she must have helped advisors and clients establish innumerable SSAS. So delighted to welcome Gemma. So morning, Gemma.
Good morning, Barry, and good morning, everybody. I'm looking forward to chatting through about SSAS this morning. So hand back to you, Barry.
Thank you. A little bit of housekeeping then. So first things first, at the end of the session today, you'll get a follow-up email. Within the email, there should be a link. The link to a questionnaire. Complete your questionnaire. You get access to your CPD certificate and a copy of the slides. We've obviously put you guys on mute to sort of manage the background noise and interference throughout the session. Doesn't mean you can't ask questions. So please do ask questions. If you use your mouse, bring your cursor to the bottom of the screen. You should see a little Q&A, so various options on the bottom of the screen. You should see one that says Q&A. So if you've got a question that isn't being answered in the body of the session, click on that Q&A button and type your question in there. We won't be taking questions as we go through the session, but we should have time at the end to answer questions then. If we don't get time to answer all the questions, which might happen, don't worry about it. You've typed your question in. We know who you are in the nicest possible way. We will follow up. So type your question in, and if we don't answer it today, we'll answer it as part of the follow-up to today's session. On the point of questions, we're going to ask you some questions as well. So through the session, there's going to be a couple of questions that will pop up because we just want to understand a little bit about your knowledge, experience, exposure to SaaS and the SaaS market, really. And that's just really, really helpful for us to understand. So your engagement with those questions would be really appreciated. All right, let's crack on then. So I never know. So I always assume there might be someone from compliance on the call today. So we make every effort to ensure the content of our presentations is accurate, is up to date, and reflects current regulation and legislation. However, we're not authorised to give advice. Neither Gemma nor I are authorised to give advice. The presentation is not, nor should it be construed as advice. Furthermore, we cannot accept responsibility for any loss that may result from reliance upon the content of this presentation. There you go. You have been told. Learning objectives, fairly straightforward, hopefully, but useful, hopefully, when it comes to completion of your CPD log entry. And here's our agenda for this morning. Format of the session, we're going to use a table to compare and contrast SIPP and SaaS. So products, features, benefits, etc. You know, compare SIPP with a SaaS. So how do they compare similarly, and what are the sort of major differences? I have the easy job. I'm doing the headlines, and Gemma's putting the detail in, putting the flesh on the bone. So this session's going to be great for me. Let's start off. So personal or occupational and membership. So what are we trying to get at here? A SIPP, self-invested personal pension, whereas a SaaS is an occupational pension. Now Gemma's going to get into this in a bit more detail, but essentially what that means, as an occupational pension, there must be an employer associated with the SaaS, a sponsoring employer, the term that we would use. Now, what that immediately tells you is that not all of your clients will be able to have a SaaS. So that's the first point. There's a differentiator. So we're already sort of narrowing the field, or another way, perhaps a better way to put it, is focusing the field of concentration here. Membership. So with a SIPP or a personal pension, typically, sort of the overwhelming majority of personal pensions and SIPPs, the pension provider will register a pension scheme with the revenue. So one scheme, but then they will issue individual policies or plans to each person who wants to join that scheme. So if Gemma and I both had a Talbot and Muir SIPP, we're a member of the same scheme, but our plan is completely unique to us. Whereas with a SaaS, it's an individually registered scheme, and it has a limited or a limit to the number of members that can join. Now, in the regulations, it refers to fewer than 12 members. I've deliberately, in this presentation, flitted between fewer than 12 and maximum of 11. Why have I done that? Because I think it's easier to remember. Because if we just use fewer than 12, then in a month's time, you'd be thinking membership. Now, something to do with 12. Is it fewer than 12 or a maximum of 12? So if we say maximum 11 and fewer than 12, hopefully that's going to be easier to remember. So there are some sort of compare contrast differences already. And as I said, I'm delighted to hand over to Gemma now, who can put a little bit of flesh on the bones around those 2 bullet points.
Oh. Thank you, Barry. But I think before we jump into and move on from those bullet points, we'll have a look at our first poll question. So I'd be really grateful if you'd just select one of the answers to this question, please. So have you advised on the establishment of a SaaS? So the 3 options are regularly, perhaps 6+ per year, very rarely, or never. So I'll give you a few moments just to select those options, and then we'll have a look at the results. And I'm really interested just to see what comes out of this particular poll. I mean, and it's fine as well if you've never ever looked at a SaaS before. Great, looks like the results are in. Okay, yeah. And actually those results are as expected. So we've got 2% on regularly, 37% on you very rarely, and 61% on never. So I think you guys are in the right place for today's session. So hopefully those of you who are on the 61% will feel a little bit more confident after today about setting up a SAS if you have the occasion to do so. Right, so just carrying on and going back to think about those points Barry started off with in regards to the table. So our first few slides are on the establishment and structure of a SAS. So in terms of sort of the SAS is an occupational scheme. It has to be set up under a trust and registered with HMRC. Barry mentioned earlier about a sponsoring employer. So there has to be a sponsoring employer associated to this with the scheme and who sets up the actual scheme itself. So I think always one of the questions that we have is actually what is a sponsoring employer, and how do we determine that the actual company is suitable to establish the SAS? So there's a couple of bits that you need to remember on that point. So there needs to be at least one employee employed by the company, which I guess makes sense. And that employee needs to be run through a payroll system. So you actually have to have a payroll system as well. So those couple of points are something that HMRC will actually review when we apply for HMRC approval when we set the scheme up. So that's just one to be aware. If you're ever unsure whether the company that you're speaking to isn't in the position and you don't know if they are a sponsoring employer, if you want to give us a shout, we can have a quick look at that particular company and check out whether we think they are a sponsoring employer. But it's one employee at least and having a payroll. So remember those 2 points. The other thing is that it doesn't just have to be a limited company who sets up a SAS. We can also look at, by definition, a sole trader or indeed a limited partnership. So it's unlikely that they do have an employee and a payroll system, but potentially they can. So if you think about, for example, limited partnerships, you could have maybe a group of solicitors, and what they might have is they might have for example, somebody who's a receptionist and they're on a payroll system. So they could actually look to utilise a SAS. So Barry's mentioned about the number of members in the scheme, and that's 11. And I also wanted to just say as well about the fact that the SAS is an individual registered pension scheme, so you end up with a PSTR number. I've said that we need to get approval from HMRC, so HMRC will supply that particular reference number to us once the scheme is set up. And the other point then is in terms of the practicality of establishing the SAS itself. What actually happens in practice is we'll start off with asking some questions on some forms when you apply for the SAS. Those forms come across to us and we will then prepare scheme documentation, which sets up the SAS, and that documentation will include a trust deed and rules. I just want you to mention at this point that with regards to the trust deed and rules, that is it is what it says. It's the rules of the scheme itself. So that sort of contains all the clauses that need to be followed to the SAS will meet its rules. So back to that point on the 11 members and who can actually be members of a pension scheme. I do have to confess, actually, I did have a chuckle to myself when Barry was talking about the fact that it can be less than 12 members or 11 members. And I do quite vividly remember when I first entered the SAS environment, and that was 23 years ago. I do remember thinking, gosh, that's really confusing. Is it 11 or 12? But after 23 years, I do realise it is 11 members maximum within the scheme. So that's my first confession for today's session. But coming back to who can be members of the scheme itself, you just need to be aware that really the members should be connected to one another in some way. So we mentioned the word sponsor and employer. They might be employed by the sponsor and employer. They might be directors of that particular company. They could be related to one another. So we just have to make sure that it's kind of not, somebody really random that you've invited to join your scheme. And actually, I don't think, in financial terms, you won't really be looking to actually invite somebody who's not associated to you. So just remember that when the members need to be connected in some way. So that's to another member of the scheme, a trustee of the scheme, or to the employer in relation to the scheme itself. And then the next important point with regards to membership is that when a member actually joins a SAS, they will become a member trustee of the scheme. So again, as we go forward in the presentation, if you just hold on to that thought, we will talk about trustees in a few slides' time. But the member has to be a trustee of the scheme. So I think that is where there is a big differentiator between the SIPP and the SAS product. Again, we've got mention of the number of members and less than 12 members, but why is it 11 members? It's actually a requirement to meet the small schemes criteria. So an occupational pension scheme has regulatory and reporting requirements. So to be exempt from some of those requirements, you need to satisfy the small scheme criteria, which is less than 12 members. So what does that mean? What would the SAS be actually exempt from? So we're actually exempt from implementing an internal dispute resolution procedure. We would then not have to produce audited accounts and a full statement of contributions, although it is recommended and preferred if accounts unaudited, albeit are produced on any SAS. And also with regards to the trustees' obligations to demonstrate knowledge and understanding of pension law, which, if you think about it, if you are a trustee of a pension scheme and you are a layperson, so you're not actually in the financial services arena in any way, shape or form, having knowledge and understanding of pension law, I think that's probably quite a big ask with regards to being able to actually meet and satisfy certain criteria. So anyway, the good news is that would be the exemption in terms of meeting the small schemes criteria. Oh, sorry, Barry. I meant to hand over before flicking on.
It's all right, no problem.
The table.
Thank you very much, Gemma. Thank you. Yeah, so back to our table then. We'll build this up as we go through the session. So the next point, which has been alluded to already, actually, we'll just sort of flesh this out a little bit. So with a SIPP, you join it, or a personal pension, of course, you join a personal pension, you take out a plan or an arrangement under a personal pension, and your responsibility really extends to making contributions, deciding how those contributions are going to be invested, and deciding when and how to take your benefits. You don't really have any responsibility beyond that. And for most people, that's absolutely fine. But with a SAS, the responsibilities do extend slightly beyond this. And as Gemma's mentioned already, the requirement for members to be trustees. Now, that can sound quite onerous. And over the course of this and the following two webinars, we want to break that down and demystify that, actually, because it doesn't have to be at all as onerous as that might sound. But it also presents opportunity in terms of the members having control, or a certain degree of control. As far as the registration of the scheme is concerned, again, really just reiterating what Gemma's already mentioned, is that with a SIPP or a personal pension, you will have a scheme and you could have thousands, tens of thousands of individual members with their own unique policies or plans within a single scheme. Whereas with a SSAS, each and every SSAS is individually and uniquely registered with the revenue. So each scheme is an individually registered scheme. So there's, again, sort of structurally, there is obviously quite a bit of difference between the two. At which point, I'll hand back to Gemma.
Thanks, Barry. So our next little section, we're going to have to look at SSAS duties and obligations, which I want to sort of go into in a little bit of detail. So first of all, let's have a little look at some of those roles and responsibilities, which I was alluding to in our previous section. So first of all, just to highlight some key roles within a SSAS. So you have a scheme administrator, and all registered pension schemes must have a scheme administrator. In terms of the SSAS, I think that's quite crucial, because members can actually be the scheme administrator, but if you compare it to your SIPP product, the SIPP trustee, so for example Talbot and Muir, would be the scheme administrator on the SIPP. But in terms then of our SSAS product, just to match that out, we're actually appointed as joint scheme administrator with the members of the SSAS itself. So really, under the SSAS, you are taking on more responsibility. But I think when you appoint a professional trustee, that professional trustee can take on some of that role itself. And I've also then sort of mentioned about trustees. So when we've produced that trustee, the members sign up and confirm, they sign up and become member trustees. So that is an official role, and with any aspects, any other, if you're looking at any trust, it's the same. You're a trustee and you have certain responsibilities. So essentially it means that the member of most registered pension schemes do not have responsibilities for the administration of their scheme, and this responsibility rests with either the sponsoring employer or the sponsoring pension provider. So if you just think about any SIPP clients you have at the moment, they won't have that responsibility to be scheme administrator. But on the other side of things, if you're looking to set up a SSAS, it's important to know with regards to the scheme administrator role, what that actually means. Similarly, with regards to the trustee role, it's also important to understand what you are literally signing up for. So, I mean, I find this quite interesting, because I've always liked looking at trust documents and reading trust documents. But I had a quick look before the session at our trustee and rules, and there's actually we've got four to 5 pages just going through what the trustees' responsibilities actually are. And I've just highlighted we've got about 5 clauses within that documentation. So I'll just reel off what it actually covers to give you an idea of that trustee role. So there's appointment and removal. There's powers, duties and discretions. There's liability, indemnity and remuneration. There's proceedings, and there's duty to keep records. So, I mean, that last clause specifically does sort of cover and go into those trustee duties. You might not want to go off and read a trustees, and that's absolutely fine. But really, as professional trustees, that really is the role that we're here to sort of help with regards to any SSAS that's being set up for the members. So it's not sort of it's not insurmountable in terms of the picture moving forward. It's best really now just to counteract that if I just sort of run through the scheme administrator duties as well. But again, bear in mind, Talbot and Muir will be joint trustee scheme administrator and take on these particular duties. So we will register the pension scheme with HMRC. We'll look at operating tax relief on contributions under relief at source. We'll look at reporting events relating to the scheme to HMRC. We'll make returns to HMRC, which will be annually, and a return will have to be submitted each year on the 31st of January for the previous tax year. There's a little bit like self-assessment, but for a pension scheme. We'll make returns to the pension regulator every 3 years, and we'll provide information to scheme members regarding, for example, the lifetime allowance, benefits and transfers, which again, I think that last point is pretty key, because if you were doing this by yourself, again, as a layperson, it's quite hard to unpick and go through pension scheme rules. I mean, understand sort of the lifetime allowance, what benefits are available on the scheme itself. I mean, it is a minefield. But nevertheless, if you're doing that role by yourself, you are responsible for those actions. And I think then just to sort of like have a look about who appoints the scheme administrator. So essentially the members are responsible for appointing the scheme administrator. Alternatively, you can take that role on themselves if they want to. They don't actually have to have Talbot and Muir as the scheme administrator. Also, other providers out there might actually insist that the scheme administrator is a member by themselves, which I don't think you would necessarily want. So just be aware of that. There are differences between different SSAS providers and the roles that they will take on and responsibilities they take on. So just make sure that you're clear when you're approaching somebody to do that SSAS work for you. No scheme administrator. So the trustees would be required then to take on that role. I'm sort of, you've realised I've got 23 years experience. So harping back to sort of where we were pre-A-Day, it's just worth mentioning that there wasn't this scheme administrator role. The SSAS actually had to appoint a professional trustee, but when pension simplification came along, the requirement for the professional trustee was removed, and the scheme then had to appoint a scheme administrator. We do see schemes that have been orphaned out there, which again I think is something that you need to be aware of in case you come across any clients with a SSAS in that position. But back in 2006, it's just worth give you a little bit of history. There were quite a few more SSAS providers out there in the marketplace, but a number of them decided to leave the market at that point in time. So what they were able to do, using their trustee and rules, was to resign as professional trustee and then hand over the responsibility of the scheme to the members. And at that point in time, whether those members were fully conscious of this fact, but those members would have been associated as scheme administrator with HMRC, leaving them in a position where they were left to go alone and work through the world of SSAS themselves. They might have then decided to pick up with another professional and appoint them. But we do still come across schemes that, if you like, were abandoned back in 2006, and now they are looking for a professional trustee to help out and to bring their scheme up to date. So just really be sort of mindful that there could be schemes out there who have been orphaned and have had no professional help over 2006, so 17 or so years. 17, 18 years or so. So yeah, just be conscious of that. Anyway, we'd be quite happy to help. We like to review those types of things, go through what's happened, update stuff. So yeah, just let us know if you've got any cases such as that. But anyway, it just shows that having the right people involved to take on those roles and responsibilities, I mean, I think is pretty essential. And again, just a contrast, which I know Barry is gonna do. shortly when we get back to that table, is we need to sort of think about where we are, you know, SIPP versus SSAS. You can see that, start to see that and build the difference. Yeah, so back to the trustees. The members of a SSAS are generally required to be trustees of the scheme, irrespective of their experience, knowledge and understanding of the role. So that's where we've mentioned all the members are member trustees. We can just on the other side, you can have something called a non-member trustee, which might happen with regards to a scheme, in particular if there's just one member of the scheme. So someone might be brought in to co-trustee with that one member, and they don't actually have to be a member of the scheme, so they don't have to participate. But just to sum up, trustees are required to maintain an up-to-date knowledge of pension and trust law. They're required under duly under general trust law to act honestly and prudently and in the best interests of the scheme members. So that is all the scheme members. It's not just you. You do have to be conscious that, you know, you could be in a scheme with 2, 3, 4, up to 11 people. So you have to have all of their interests, the best interests for all of the scheme members in hand. And you're also, there's a requirement to regularly review and update the scheme documentation to reflect changes in pensions legislation. But very importantly, no pensions law doesn't stay the same. You know, every budget we expect something different to happen. So yes, so it's quite a role, and actually having the professional trustee there to guide the member trustees it is recommended and good for the scheme. So let's get back to Barry for back to the table.
Lovely, thank you very much, Gemma. It has occurred to me actually that you know, there's no getting away from it. The idea or the prospect of your client being a trustee of a registered pension scheme might be a little bit intimidating even for you to have that conversation with a client and to put that forward to them. But 2 points I make really, and it's only just occurred to me while Gemma was talking. I'm not sure why it's only just occurred to me. Any number of you, I'm sure, will throughout your career have recommended, almost certainly I would guess for most of you, some trust-based estate planning solutions. So loan trusts, gift trusts, discounted gift trusts, reversionary trusts, or even term policies written in trust. So actually, you've probably already recommended clients to become trustees of trusts. Like I'm not suggesting it's necessarily the same thing to be the trustee of a discretionary trust to being a trustee of a registered pension scheme. But the difference here is that you do have a professional trustee sat with you. So it's perhaps not as onerous as, you know, as we immediately might think it is. Without going through each and every one of these tabs, just as almost as a form of summary, really, you know, what do you get by having a professional pension provider behind you? You know, Talbot and Muir will establish the SSAS. They'll get the SSAS up and running. If there are going to be employee contributions and relief at source needs to be operated, they'll operate relief at source. They'll administer the contributions, make sure the contributions are invested. Benefit payments to members will be administered. Open and operate a SSAS bank account, make the reporting to the relevant authorities. So, you know, an awful lot of this stuff is there with your professional provider in the background to help you. So it's just really, really important. Like just that point Jen was making, you know, someone may be offering a SSAS solution. You just need to understand exactly what it is that solution includes. Back to our table. So pooled investment funds. Okay, I reckon even for those of you that have never had any dealings with SSAS, you know, we've all read the 2 or 3 paragraphs in the study manual that referred to SSAS. Apparently that was enough, you know. But there'll be little things in the back of your mind and you think SSAS. Let me think. Well, occupational, I think something about 12 members, but I can't quite remember how that works. So something about loan backs, and we'll get to that in a bit. And one of the things that might be in the back of your mind is this concept of a pooled investment fund, which I think is probably best illustrated with a diagram, which I'll come to in a moment. So just to sort of clarify this point then, so Talbot, with a Talbot and Muir SSAS, Talbot and Muir will act as joint scheme administrator, but essentially doing the heavy lifting for you there. TM Trustees Limited will act as the professional trustee, hand on the shoulder of the member trustees, and we operate a pooled investment fund, or as the slide refers, a common trust fund. So what does that mean? Again, I'm kind of visual. I like visual. So SIPP, we have a registered pension scheme. But in my example here, we've got 5 members of that SIPP. They've each got their own unique and individual policy or plan. And each of them has their own unique individual investment strategy. So each of those 5 members, completely unique and separate investment strategies. With the SSAS, we have a scheme, but the members are investing in a pooled investment. So, for example, we have, let's say there might be a commercial property in there. There might be a discretionary management portfolio. There might be fixed term deposits in there. Each of those members of that SSAS will own a proportionate share of everything that sits in that pool. So in the very unlikely event that those 5 members have a 20% share each, they'll each have a 20% share of the property, 20% share of the investment portfolio, 20% share of the fixed term deposits. More likely, of course, some members will have a higher proportionate share than others. So one member might have a 40% share, someone else might have a 5% share, but they share this pooled investment structure. Now, I'd say we have to be honest about the fact that the pooled structure represents both opportunities and some challenges. So the obvious challenge for me is, if you use my example there of a 5-member SSAS, that could be 5 members spanning 3 generations. So you could have someone who's literally just started their pension accumulation journey and someone else who's maybe only a year or 2 away from drawing benefits. So managing risk it's not an insurmountable issue. It's just thinking about things differently. So with a SIPP or a personal pension, each individual person has their own plan, and the risk profile of that plan will be, bespoke for them. But with a pooled fund, it's just a conversation, and this is the value of advice. These clients will want advice on how to manage the risk profile of a pooled fund with multiple members that might span multiple generations. On the other hand, of course, that pooled funds may offer benefits and advantages. For example, economies of scale. So, it's not that it's an insurmountable issue. It's just a different way of managing things. And I think we'll probably talk more about that in the 3rd session that we deliver in a couple of months. Investments then. So, assuming your client wants to invest out with the normal personal pension range of investments, collectives and insured funds or whatever, self-invested personal pension, self-administered scheme, commercial property, SIPP or SSAS, absolutely fine. What about discretionary fund management? And by that, typically what we're talking about is discretionary fund management with the fund manager having custody of the assets, so they can manage the client's portfolio, rebalance, buy, sell, trade through their own custody rather than through a platform. So that's kind of why you might want that. SIPP, yes. SSAS, yes. So we're pretty similar so far. Borrowing, typically that's going to be borrowing to purchase a commercial property, so a mortgage. SIPP, yes. SSAS, yes. So very, very similar. So where is the difference and where do we differentiate ourselves? Well, then this is where we get to the loan back, which again is probably in the recesses of your mind. It's in that list of 4 or 5 things that you can vaguely remember about SSAS. So a SSAS has the capacity to lend money back from the fund back to the sponsoring employer. And again, at this point, nice hospital pass back to Gemma, and she'll run through that in a little bit more detail.
Thanks, Barry. So I'll start this one off by actually chatting about SIPP. So just to reiterate that obviously the SIPP doesn't have a sponsoring employer, so can't make a loan back to a sponsoring employer. If you do end up under a SIPP for some reason making a loan to a member or a person or company connected to the member, the loan would be taxable. So we end up in that space where you have an unauthorised payment, and you end up with tax charges on the pension scheme. So definitely steer clear of any conversation with regards to sort of connected loans under SIPP. The good news is, under the SSAS, if you do want to look at using the SSAS product to loan money to the sponsoring employer, this is available, and you can lend up to 50% of the scheme assets. So all the assets in the scheme, so everything is, as Barry has said, is pooled. So everything is added up, times by 50%, and that's the amount of loan back that can be granted from the scheme. Now, loan backs are subject to strict conditions. And if you they're on the wrong side of the line with regards to those conditions, again, you can be looking at tax charges on your pension scheme. So we'll always want to make sure that the loan back requirements are satisfied before actually granting a loan. So let's have a look at the particular tests, we call them, with regards to the loan back. There are 5 tests which we've put up on the slide, and I think before I just run through the tests, I think just to make you aware that with regards to who you grant that loan to, it does have to go to the sponsoring employer themselves, and it has to be, those funds have to be used for the purpose of the sponsoring employer's business. And you can't basically use those funds either to sort of hold up a failing business. They actually should be for the purpose of things like, business development purposes. If somebody is looking to purchase some particular bit of machinery using those funds, that's fine. That type of thing is perfectly acceptable. So before granting that loan back, let's have a quick look at the 5 tests that need to be satisfied. So the first one is security, and so there needs to be a first charge on an asset of at least equal value to the loan. At Talbot and Muir, we will look at commercial property, we'll look at land, and we'll also look at residential property, but we won't look at the main residence of the individuals. So that is, that's what we'll look at. I know there are other SaaS providers out there who might look at things like to secure against, again, machinery, big pieces of machinery, things like IP potentially they might be used, but Talbot and Muir won't look at that. The next test then is interest rates. So the minimum interest has to be 1% above the high street bank-based lending rate. The maximum term available for the loan then is a maximum of 5 years. We've mentioned the maximum amount, so you can't go above 50% of the market value of the net scheme assets. And then it's also important to understand that the loan is on a repayment terms basis, so capital and interest needs to be repaid to the scheme on a regular basis. So at the start of that loan, the clients would be provided with a loan reschedule showing all the payments that need to be paid. So you don't get to the end of the term and then repay the loan. You actually have to do that across that 5-year term. So I think that one's just an important one to be aware of. With regards to my experience, I think that the test that normally you're not able to go forward with is the security. It can be difficult to find a first charge on an asset that's property, and usually that's where the conversation will sort of sadly stop with regards to the loan back. But again, we're quite happy to sort of chat through those tests in detail, go through them, and chat again. We can actually chat with clients about that as well with you there. So I am now going to bring up our next poll question, if we can. And by the way, don't forget, if you have got any questions that you want to ask us, don't forget about the Q&A box. I know we've got questions coming through. So poll question number 2. So where you have advised or assisted in the establishment of a SSAS, what was the main reason for using a SSAS? So to pool funds for property purchase, for family business and intergenerational planning, loan back or potential use of loan back in the future, or other. For those of you at the beginning of the session on poll question number 1, I know there's quite a few of you that haven't set up a SSAS, but I guess, I mean, if you could answer this question, maybe thinking about your clients, what they might like to, what they would use SSAS for, that would be really greatly appreciated. We've got some answers coming through. Brilliant. Oh, here we go. So, yeah, again, the answers to this are pretty much as expected. So we've got to pool funds for property purchase, 30%, family business and intergenerational planning, 48%, loan back, 18%, and 4% of you said other. That is really interesting. So we do see commercial property purchase where there's two or more members, so they look at the SSAS option if they can create the SSAS, and then actually intergenerational and family business planning, that is that's another one that we do talk a lot about and see a lot. I'm going to hand over to Barry.
Thank you very much.
Thanks.
I mentioned earlier the fact that there might be some little memories of SSAS in the recesses of your mind, and as we go through the session, you're thinking, oh yeah, loan back, I remember that now. And I'm sure there was something about like a 5% rule or something, and shares, something like that. So before you get too excited, we've only put this in the presentation for the purposes of completeness, because if any of you thought, why didn't they cover that? That seems like an obvious omission. Before we even get into the slide, I'll just say, the likelihood of being able to use this is negligible, and actually we're told that we won't allow it, but we've got this covered in the presentation for the purposes of completeness. So technically a SSAS can invest up to 5% of the value of the scheme into the shares of the sponsoring employer, and if there are multiple sponsoring employers, then subject to that 5% per company, it can invest up to 20% of the value into the shares of the sponsoring employers. Whereas with a SSAS, there is no sponsoring employer. So sort of think this wrong. I want to basically explain why we don't offer this really, but we've only covered it, because like I say, for the purposes of completeness. So at a very high level, without wishing to get into too much detail or depth, you have a client who owns and runs a limited company. It's their business, and they have a SIPP. Now, it's their SIPP and it's their company, but that company is not the SIPP sponsoring employer, because the SIPP doesn't have a sponsoring employer. And a SIPP, just like a SSAS, can invest in the shares of an unlisted company. The difference with a the SIPP could invest 100% of the value into the shares of the unlisted company, but your SIPP provider shouldn't let him. Why? Because where the shareholding of the member combined with someone connected with a member, so let's say a spouse, plus the pension scheme, where that combined shareholding exceeds 20%, the SIPP then has to do a lot of due diligence to check whether, because we've got all these connected parties here, whether there's a taxable property issue. Would the SIPP, in purchasing those shares in that unlisted company, acquire an indirect holding in taxable property? For example, residential property, or much more likely, tangible movable property. And the reality is, in the vast majority of cases, the answer to that question would be yes, it would acquire taxable property, and therefore it would attract tax charges. So you've got a client who owns their limited company, their SIPP shouldn't really be investing in that limited company. So what's the difference with a SSAS then? Well, the SSAS can invest up to 5% into the shares of the sponsoring company. So that feels like it's a differentiator. Well, kind of is, but it also isn't, because that same rule applies. In all likelihood, by the very nature of a SSAS, and not all members of a SSAS will own shares in the company, but very often a SSAS will be set up by the owners and directors of that company. So it's quite likely that we're going to breach that 20% rule. And therefore, we've got an issue with indirect holdings of taxable property. It sounds all a bit technical, but the nub of it is we've only covered this point because it would be remiss of us not to put it in here, but we don't offer it. Okay, you might find that it is offered elsewhere, but it ain't offered. But in reality, it's one of these things. It's like, you know, that 2 or 3 paragraphs on SSAS in your study manual, this takes up a disproportionate amount of text. Okay, and as we've already covered from the previous poll question, it's really not something that people are demanding. Okay, so the next question then, compare, contrast, back to our table, retirement options. Client wants to draw their benefits. They want to take a PCLS. Clearly, you can have a PCLS from a SIPP, but what about a SSAS? Yeah, of course you can. Client wants to go into drawdown, flexi access drawdown? Yes, why not? UF plus, yes, why not? And can the money be used to purchase a lifetime annuity? Yes, why not? So I say why not, because although, you know, one is personal pension, one is occupational pension, etc., the reality is they're both registered pension schemes. And so the retirement options available are available to both. Now, Gemma made a point earlier about the importance of reviewing trust documentation. So it is worth keeping your trust documentation up to date. So, for example, 2015 pension freedoms, flexi access drawdown, UF plus were introduced. They simply didn't exist before. Now, technically, because I think the Chancellor was desperate to get a bit of revenue, he said, flexi access drawdown, UF plus, they simply do not exist. Therefore, they're not in your pension scheme rules. So therefore, go and change your pension scheme rules to offer them. But if you don't want to do that, or you can't afford to go through the paperwork to do it, we'll offer you what's called a statutory permissive scheme rules override. So you can make those types of payments, even if it's not in your scheme rules. However, just because that statutory permissive scheme rules override exists, doesn't mean all schemes will want to use it. So I just want to wheel this one back to what Jen was talking about earlier and saying, look, the value of having a professional body behind you means that your trust documentation gets reviewed. So in 2015, a well-run SSAS scheme rules would have been changed to say, oh, by the way, you can now have flexi access drawdown, and we can now make UF plus payments, etc., etc. So the scheme rules can be updated and amended to accommodate changes in legislation. This is particularly timely. We've just had the LTA charge removed, and we've got imminently in April, 6 months away, the LTA being removed altogether. But the way the draft rules are written, the LTA is going to be replaced with some new allowances and limits. So this is a perfect time, very timely way of thinking, right, actually, do I want to run this SSAS on my own, or do I want Talbot and Muir behind me to help me keep the scheme up to date? Looking at the table, I would say more similarities than differences, but the differences are, you know, significant. Obviously, some people can have a SSAS, some people can't. Some people will want a SSAS for reasons that they can't use a SIPP for. That's kind of my summary slide. I've just used my summary slide up already. Similarities, loads of similarities, but also some crucial differences. And a SSAS, as well as coming with certain responsibilities on the member, also presents additional flexibility and investment options as well. So a certain degree of control in respect to the members being trustees of the scheme as well as members of the scheme. Looking at our time, so let's have a look. I did see that we have had some questions come in, Gemma.
Yeah, we have.
Want to see if there's any that I can answer.
Go on then. I think you can answer one. Shall I?
Let's have a go. Well, hang on. Can there be more than one sponsoring employer? Well, now I know the answer to that is yes, you can have multiple sponsoring employers. But I'm interested, Gemma, from your perspective, from a practical, you know, reality perspective, do you see that, and how often would you see it, and sort of what can you tell us about that?
So what can I tell you? I mean, I think the last time I was actually asked recently about how many sponsoring employers you can have, and somebody we had someone who wanted to look at setting up a SSAS, and I'm trying not to give anything away in case they're on the call, and they were looking at 10 employers to join, and that actually I think that's the most I've ever seen. Normally it's like 1 or 2.
Right.
Generally it's to make contributions potentially from different companies within your own whatever structure that you're operating outside. So yes, you can. We would, if you're looking at 10, I think what we'd suggested on that one was that they established their SAS and then we included the other 9 companies once the scheme was established. Nice. Because you can do that and you can add another participating employer to the scheme at any point in time as well, just like you can add a new member to the scheme. So it's an adjustment of the scheme rules. We produce a new deed, and yeah, they're then included in the scheme.
So there you go. I knew the answer, but I didn't have
Barry.
But the value in your answer, Gemma, is I'm thinking, but why would you? And of course, it's contributions, profit extraction from multiple companies, perhaps within a group or associated group of companies. Yeah, brilliant.
Yeah.
I think this goes back to our original poll question. We'd discuss more often than rarely, but take up would typically be put back to another time. Perhaps some of the mystique needs to be removed. Well, yeah, hopefully we'll kind of go some way towards achieving that over this and the next couple of sessions. So yeah, I think
especially in that last session that we're doing should do what it says on the tin of myth busting, we hope.
Is the ownership of the pooled fund investments relative to the contributions of the member? I think the way I would put it is that the ownership is proportionate relative to the fund values of the member. So it might be that you've got 5 members all putting in £1,000 a month, but one member may have transferred 100,000 in. So his value would be 100,000 plus his contribution. So it would be proportionate to their total value. So that would be contributions plus any transfers as well.
Yeah. So any good professional trustee will also make sure that there's a track of everything. So you'll end up with a valuation every year, just detailing what proportion of the share belongs to each member. So it's very clear what, as the contributions come in, or indeed if you're making an F plus, taking tax-free cash on the way out, that's all managed. And everybody knows what effectively their share of fund is.
And this goes back, doesn't it, to having the support there, because like you say, it's not just what comes in, it's what's going out, and you've got a potentially constantly changing or shifting proportionate balance of relative funds for the members. Which we'll deal with. But I've got a feeling, Gemma, I am going to throw this one over to you as a hospital pass. I can see you're in the first line of this one. Why not have a floating charge on stock, book debts, etc., as an acceptable security with an interest rate appropriate to the absence of the total adequate property charge?
Thanks for throwing that one.
Well, do you know what? I probably need to have a sit down and have a reread of that a couple of times.
Yeah. But, I think, well, basically, as a company, we've taken the decision just to allow those particular parts property as security, because its value generally you keep the value. You can, if the debt needs to be bought in, you're not really too concerned that actual value of the property is going to be below the debt. I think we might have a look at that, if that's all right, offline with that particular the person who's asked that particular question, if that's all right.
Okay, not for today, but I think one of the questions I would like to hear more about over the series is what happens if members want to exit, fall out with each other. So we really are talking day 2 administration going on. So I mean, as you've said, David, maybe not for today, but we will. That is what we very much want to get to grips with in the third of the series of webinars, is that day 2 administration. Now the scheme's up and running, where do we go now, kind of thing. So unless you want to get into the detail of that now, Gemma, but I think we're hopefully going to cover that later.
Similarly, I think we've got one other question there, which that would also be a lot of detail actually in my answer, and I can see we're coming up to 11. So we've got more, I think. So anybody, I think we've had quite a few more coming through.
Yeah, we have. It's a bit of a flow.
So no to crypto, that's an easy one.
Yeah, sure.
Do that one. Maximum levels of contributions. again, as per the annual allowance, and carry forward availability for the member.
Would I be right in saying, Gemma, typically with a SSAS, typically the bulk of contributions will be employer contributions?
They will,
as well?
yeah. You do see some employee contributions, but typically it's an employer occupational pension scheme.
Almost. Why wouldn't you?
Yes, yeah. Any more I can answer really quickly.
Must there be regular contributions for a member, or can it be established from transfer in only?
Yes,
it can be transfers only.
Transfers only, yeah. Transfers only, or contributions only, or both.
Was the earmarking one that you were going to take a bit of detail on?
I was going to say, maybe we can chat about that in one of our next sessions. So I guess Barry, if we, because we just,
I think that earmarking question relates slightly to Jeff's question as well about equal ownership of property if values are disproportionate. So we'll pick that up separately.
Fantastic. Some really good questions there.
And again, we are running out of time, but I will quickly cover this. Both the SIPP and the SSAS can invest in commercial property, but can the SIPP also borrow to invest? Yes, both are able to borrow subject to the availability of lending in the marketplace. Yes.
Yeah.
Sorry, we're slightly over time, but that's because we've had a bit of a rush in questions at the end, which is great. So thank you very much for your participation. So we'll call a close to the session there. Hopefully you found the session useful. You will get a follow-up email, like I said, with a link to a questionnaire to access your CPD certificate and your slides. And keep an eye out for the invitation to the second part of our series of 3 webinars. So thank you very much, everybody.
Thank you.
And, see you soon.
See ya.